But I want to start by asking our two panelists to do a quick introduction of themselves. And we're going to start with Eitan, who's on my left right now.
Thank you, Andrew, and good to see you, Woody, again. Thanks all who are out there who are attending. My name is Eitan Butler. I'm the chairman at Dalmore Group. Dalmore is a FINRA and SEC registered broker-dealer, investment bank and technology platform that focuses at this point exclusively on helping companies raise capital online through a number of different securities exemptions. To date, we've onboarded over 1,000 private companies made up between Regulation A, Regulation D, Regulation CF. And it's great to be here and look forward to our discussion.
Awesome. Thank you very much, Eitan. Woody, please.
Great. Thank you, Andrew. Thanks for having me. Eitan, great to see you as always. Doug, where are you? I'm sure Doug will be with us shortly. Woody Neese here. I'm a principal at Crowdfund Capital Advisors. We sort of sit at the epicenter of what we see as three big themes. One is data. So we built a data aggregator called CClear that collects information on every single regulation crowdfunding, I should say, offering that takes place. So we're going to be talking about the exempt offering marketplace, but we really focus on Reg CF. We do dabble in the 506Cs and some of the Reg As, but we have a 100% complete data set on Reg CF. We use that data to feed into an algorithm, a machine learning algorithm that we created that looks at all the offerings to see which ones have signals for companies that are going to go on to do what we believe are great things. And we built a venture fund called D3VC around that. And then the third company that we're part of is called Guard, and it helps facilitate liquidity in these issuers that are raising money under these exemptions, such that if you want out of your investment prior to a sale, an IPO or a merger, you can sell these securities on an alternative trading system, and Guard is the compliance technology tool that will facilitate that.
So, awesome. Thank you very much, Woody. First of all, I'd like to mention the two panelists we have here right now. I want to make a quick comment about Dalmore Group and Eitan. In my opinion, they represent kind of a new iteration of online capital formation securities crowdfunding because they're taking a slightly different approach than probably the first platforms that have joined this space. And so Dalmore has really emerged as a very robust platform for issuers to raise money online, and it facilitates the full stack of exemptions. So I've always been watching this platform very closely since Dalmore Group came on the scene. And then, of course, we have Woody from CCEA. He's the original OG because he helped to create the Jobs Act of 2012. So we're always very fortunate when we have experts like this participate in these webinars because they understand this stuff better than anybody else in the community. And they certainly understand it far better than I do. Hopefully Doug will be here in a second. We've been in communication with him. We know he's trying to circumvent the technical issue he's having, and I'm certain he'll find a way to join us. To kick things off, let's talk about the Jobs Act of 2012. This is the legislation that created securities crowdfunding, and in effect, the Congress created three exemptions, security exemptions, that enabled issuers, firms to raise money online. There was Reg D 506C. That's only for accredited investors, but many platforms that offer securities crowdfunding leverage that exemption. There's Reg A Plus, where an issuer may raise up to $75 million in a light disclosure environment, where you have to have the offering approved or qualified by the Securities and Exchange Commission. And then we have Reg CF, which is kind of the namesake exemption. That's an exemption that enables an issuer to raise up to $5 million from anybody, from an accredited and non-accredited investor. There have been a couple changes to these exemptions over the past years. While the law was approved in 2012, it took the Securities and Exchange Commission quite some time to put the rules together for CF. The final exemption really was not actionable until 2016. But since that time, they have made a couple changes. Most importantly, they increased the funding cap from $1.07 million to $5 million, which made a lot of sense. Reg A Plus was tapped up from 50 million to 75 million, and maybe these will go up in the future. We're going to talk about that in a minute. But where I wanted to start off was with Woody. Woody and his company recently did a trends report on the crowdfunding industry, and I've reviewed that document. We wrote an article about it, and I think it's enlightening to hear what the data is showing today. So I'm going to kind of pass the mic over to Woody and ask him to spend a couple minutes to kind of share the trends for the security crowdfunding industry right now. So Woody, go ahead, take over.
Okay. What I'm going to do is I'm going to just go over some of the slides. So I'm going to bounce in between a few of them for you guys, just so you could see what's happening. But I'm going to give a quick little highlight of the industry to date, and then I'm going to just show you some of the bar charts that show you trends that are happening in terms of capital formation, in terms of deal flow, in terms of issuer sentiment, because I think it sort of lays out a picture of how this industry is rationally evolving, how capital is logically flowing, and how we're able to fund women and minorities in a way that VCs can over in Silicon Valley. So with that, this slide here is through December 31st, 2023. It's actually much higher now. So as of 12/31, there were 6,800 issuers that have run 8,000 deals. This morning, when I was looking at the data, we're breaking 7,000 issuers and 8,300 deals. So you've got issuers that are doing multiple rounds of financing online. I think that's one of the greatest arguments for why this should increase, because this now has become an area where companies can come online, raise capital, and not only execute what they want to do with that capital that they're raising, but come back on these platforms again and do another round. So it doesn't mean that you can't go to VCs or more sophisticated type of capital or a Reg A deal later on, but this is really a great starting area, I think, for a lot of these issuers that in the beginning were just startups, but now we're starting to see more established companies coming into the marketplace. This is taking place all over the country. So when we look at the issuers and the cities that they're located in, there's about 1,800 cities that have been represented all across the United States and all the states in the union, including the District of Columbia, Puerto Rico, the U.S. Virgin Islands. It's amazing. It's just, the appetite's everywhere across the country. And this is still relatively unknown. Like if you walk down the street, people just don't know what regulated investment crowdfunding is. So I think we're just really in inning 2 or inning 3 of what this industry really stands to be. The total amount of capital that's been committed is now actually over $2.3 billion. And that's money that's going into companies that are creating jobs. As you can see, 310,000 jobs have been created or supported by this legislation. These companies are not only taking that money in from investors, but they're buying products and goods. Cost of goods sold, of course, falls in that category to help run these businesses. And since these companies are distributed across the United States, a lot of the expenses that they're incurring are for local suppliers and vendors. And why is that important? Because it doesn't necessarily, it's great to say that we're pumping money into our economy, but what we really want to be doing is creating local jobs. What we really want to be doing is helping create stimulus in these local economies. And I think that's what this legislation inadvertently happened to do, because we're pumping, and we can see this because we track all the financials of these companies. They're pumping about $6.8 billion annually into local economies all across the United States. So whenever I'm talking to government officials at a state level, I keep on focusing on the fact that you really should be thinking about how can we get more people educated as to the promise and the opportunity of regulated investment crowdfunding, or really any of these exemptions, just for the jobs and economic stimulus impact that it can have in your state or local community. The enterprise value, I think, is a really critically important thing. So we track valuations of these companies from when they do their first round of financing through their iterations over time, and we can see the valuation growth. And so, $2.2 billion has been invested in. These companies are worth $75.6 billion based on an aggregate amount of their most recent valuation. And what I love to point out about this, and we're starting to see this because, this is early stage financing. So So it's very much like venture capital financing. You know, when they go in, they make an investment in their horizon 7 to 10 years. Well, we're 7 years into this now, so we're starting to see the exits happening, and we're going to be seeing a greater velocity of these exits happening over time now, particularly from that 2016, 2017 vintage group of companies that raise money online. So what does that mean? It means that people are going to be getting their money back, and it's very likely that people that are not necessarily accredited investors but decided to invest in these companies that are local, where they knew the entrepreneur, loved the concept, believe in what they were doing, are, stand to gain a lot of money and potentially millions of dollars. And so I love to point that out. And this just compounded annual growth rate just proves a lot of what we talk about, which is this industry is growing. Like, it's scaling. We're at 59% compounded annual growth rate, and it's not slowing down. With the caveat that we did see a slowdown in 2023. I think that had to do with a lot of geopolitical and macroeconomic events that were taking place. There was, this market's not insular from what happens, at a federal level even. So when we've got, supply chain issues, when we've got hyperinflation, when we got the Fed raising interest rates to try and pull it into control, all of that has an impact on how issuers behave. It has an impact on how investors think about where they should be deploying capital. And the charts that I'm going to show you, I think, plays that out. So what I want to say is this is deal count by year, and you're seeing that trend line going up over time. 2022 had the highest amount, but like I said, there was a pullback in 2023, a slight pullback, when issuers like, well, maybe the timing's not right where I should be going to market to this. I don't think 1 year should reflect an entire industry. And I think that we're already seeing in Q1 of 2024 a reversal of this trend. So I do think we'll be pulling out of this dip that we saw in 2023, and we're just going to continue to see this upswing. What will drive more deal flow into the marketplace is just awareness. More people, as they become familiar with these issuers that are raising money online, will spread the word that other companies can do this as well. Plus, as soon as we have one of these offerings that goes public or has this massive exit where many retail investors become millionaires, I think that's where your media, your Today Show, your CNN, they're going to be doing stories on how did this happen? And I think that's going to really drive awareness and deal flow into this marketplace. And this slide just shows you what's already happening in Q4, which was a turnaround in terms of deal count. But let me switch over to a couple of these slides. The age of the issuers is changing dramatically. When the industry started, it was 2 years old. Now it's over 4 years old. If you look at if they're startup or established, that age thing again, in the beginning, it was a lot of startups, so less than 3 years old. Now the majority, not the majority, but we're having more and more of these companies are established issuers. So the risk profile is changing. They're making more money over time. The average revenue in 2023 of these issuers was over $1 million. And we are seeing that the profile, the dynamics of these companies has shifted from pre-revenue companies to post-revenue issuers. And what I like to talk about in this is when we went to Washington and we were pushing this out there, a lot of the pushback that we got was, well, grandma's going to lose all her investment because these are untested companies. Nobody knows anything about them. And what I love to point out now is, well, the data shows that these are established companies that are making money. So they've proven their business concept and they just need capital to scale and grow. So the risk profile has changed dramatically. Just a few other data points and we can jump back into the conversation. This has worked tremendously well for women and minorities. We track women and minority founders by the offerings so we can see what's happening. And in 2023, 41.7% of them had at least one woman or minority founder. Now, if anyone that's raised money from venture capitalists that's a woman or minority will tell you it's nearly impossible. Only about 2% of women and minority founders seem to be able to break through those barriers and get the capital. So this only stands to mean that in the future, more women and minorities will come online and more women and minorities will benefit from this legislation. This data point I thought was really fascinating because companies that raise money through investment crowdfunding have to file annual reports. And yes, the compliance is something we could talk about because it's not It's not perfect, and I want to see that improved. But where we do have annual reports and we can track what's happening with these companies over time, we wanted to see between the year that you did your round of financing and the following year, how have revenues changed on average? And we saw a 284.5% increase in revenue. So something's happening with the money that they're raising from the crowds. Maybe it's allowing them to achieve their marketing and sales goals that they want. Maybe it's that investor base that they brought in and they're using them to help increase awareness about the company and what they're doing. For one reason or another, it's leading to these results. And I think that's really, really powerful. The other thing that I want to point out is the Bureau of Labor Statistics often points out that 50% of all new businesses will fail within 5 years. We decided to go through all 6,800 companies last year to see if they were still in business, and we used their website as a proxy. And that's not 100% perfect, but it is a proxy for trying to determine if a company is still in business. And what we found out is that only 17.8% of the companies that were successful in their raise through investment crowdfunding were no longer in business. So if you raise money in crowdfunding or regulated investment crowdfunding, arguably you're most likely to stick around. So I think that's a really important thing. Just the last thing, I want to talk about the number of checks written and the total amount of capital that's been committed. So you saw that between 2016 and 2021, just a skyrocket, where in 2021, over $500 million alone was committed. And then we saw this drop in 2022. And in 2023, I was telling you about how, these global and macroeconomic events were having a pullback in terms of deal flow. Well, that was not the case in terms of investors deploying capital. There were fewer investors, and I'll show you that chart as well in a second. As a matter of fact, it's this one right here, just so you can see it. This is the number of checks written, hit a high in 2021, fell back in 2022, and was pretty much flat in 2023. But if you go back to this chart, you can see that the investors that were in the marketplace are like, I'm going to place bigger bets because I see, a greater opportunity maybe in this. And so we're seeing that dollar figure stay up there, which means that check size is greater over time. The only other thing, yes, yeah.
So I want to, keep this thing going because we don't have too much time. But in general, you're seeing a lot of positive indicators in spite of the economic challenges that we've seen in the past couple of years.
Absolutely. I mean, you would think it's doomsday where you look out and, other parts of the market and all that stuff. But in our little world that we're in, we're just seeing, a constant up and up. I mean, the pullback that we saw here is not reflective of the pullback that we saw in the VC world. VCs were down, investment crowdfunding, more deals were up, so, and the percent of dollars that are committed within investment crowdfunding is increasing over time. As a matter of fact, when you look at what angels do, this marketplace captured more of what angels did in 2023 than they did on their own.
Yes. Okay. All right. So I wanted to give Eitan an opportunity to jump in here because we have seen a pullback in venture markets globally. So it's not just the United States, it's kind of everybody. We read the reports, again and again, things are kind of choppy. Eitan, from your perspective, from Dalmore Group, your point of view, what are you seeing right now today in this market of online capital formation for these three exemptions? Are you seeing things pick up? Are they holding steady? Are they going down? Does it just depend? What are you experiencing at Dalmore?
So we've been experiencing a very steady increase in applications from issuers who want to learn more about how to properly leverage these exemptions. It's confusing for many founders, this whole alphabet of exemptions and which one to consider first and why. Most of what we've been up to over the last 6-8 months or so has been focused on Reg A and Reg D. Our issuers have been raising consistently about over $50 million a month or so. And we're more recently, we're experiencing a number of applications for Reg CF, oftentimes done in conjunction with a Reg D. And we have our usual increase in these fractional share Regulation A platforms. These are issuers who are fractionalizing assets or royalties and utilizing Regulation A to sell these securities to almost anyone over the age of 18 in the right jurisdictions. I would break up the issuers into kind of two buckets generally. One are clients that are considering, real startups that are looking at Regulation CF and Regulation D, looking at this as a kind of a one-off capital raising exercise, kind of compared to what they would look for if they were approaching VCs in a way. There are others, issuers, who are looking at these exemptions in a more perpetual, ongoing perspective. So they're using Reg A to raise up to 75 million per year, not just one time. And the ones that are utilizing these exemptions on a continuous basis tend to be more structured, more similar to funds and REITs or bond issuers that are not just looking to raise 75, they're looking to raise as much as they can over an ongoing period of time to build community and to keep, and to continuously use these exemptions year to year. But in general, we're seeing a rise in, I guess we can call it like sophistication of the issuers, where in the beginning, it was a relatively new industry. There were all types of structures, all types of industries that were opening up. There was the rise of these marketplace platforms that would list many different types of offerings in many different industries with various structures. And I think that it's moving towards more of a specialization at this point, because I think investors are also getting more sophisticated and smarter, right? There's only so many investments that I'm going to make if I, on an online capital raise platform, if I'm not seeing either liquidity or return in some way. And so it felt very novel in the early days, but I think that that gets old quick, and people gravitate to quality, and they expect to see some type of a return, hopefully, on their investment. So I think as a result of that, issuers are getting more sophisticated in how they're approaching these exemptions and which ones to start with and how to grow their business lines accordingly.
Yeah, so you made many good points there, Eitan. There's a couple there that I'd like to highlight very quickly. First of all, the repeat issuers, people that are raising money in consecutive rounds, and perpetuals, serial issuers. I think that's an interesting development, because I think all these exemptions was kind of like initially thought of as one and done, but that's changing. And I also personally think that there's an opportunity to be more like a VC and do like Series A, Series B, Series seed sort of thing. And I think that's an awesome development for the industry overall. Also, the fact that you're seeing more mature businesses get in there, because I think the more mature the company is, the lower the risk is. That doesn't mean that we should go away from early stage startups, but I think that as the industry evolves, that's an important characteristic of it that is overall positive. So I want to jump to what could be forthcoming for the industry. Again, this is a subject I love, compliance and regulations. Some people think that there's something wrong with me. I can bore people to tears talking about this stuff, but I get a kick out of it. And we've got two experts here, and I'm going to start with legislation that was recently passed by the House of Representatives. And first of all, excuse me, the sponsor of this bill is Congressman Patrick McHenry. He is the chairman of the House Financial Services Committee, and he has been like the shining star in Congress that has been advocating on behalf of this industry, consistently. And unfortunately, he's decided to retire at the end of this year, so we're going to lose a very solid and consistent voice for the industry. But he's been awesome, and I think as one of his parting shots to Congress is he has introduced the Expanding Access to Capital Act, HR 2799, and he got it. It was approved by the House just recently, and now it's over in the Senate Banking Committee specifically. So it's a very long piece of legislation, but there were a couple items here that I wanted to kind of highlight. And I'm going to start with the micro offering exemption, where an issuer can raise up to $250,000 a year, basically with I don't know if there's a notice filing or what. And one of the Silicon Prairie mentioned this exemption here on our chat, and they're spot on. But I'd be curious to hear, we're going to start with you, Woody. What's your thoughts on a potential micro exemption and how it could impact the industry? Is this good for platforms, not good for platforms? We don't know. What are your thoughts on a micro exemption?
It might be a little controversial, but I think, regulation crowdfunding sort of fits what they're trying to accomplish with the $250,000. I see the fact that people don't necessarily want to pay for the cost of compliance, have to go through those hurdles just to prove, a concept or to get $250,000. But I sort of like what we did with, the framework for investment crowdfunding, only because we were trying to address the pushback that regulators were going to have to opening the doors to access to capital. And one of those is you just can't, put a hat out there and say, give me money for my business. You need to actually have a structure under which you do it. And I feel like investment crowdfunding does that through the disclosures that are mandated, through the compliance that you have to have in terms of, when you raise money, you have to file with the SEC to let them know. When you close your offering, you have to give them updates. Not that all of that couldn't be scripted in if this $250,000 exemption were to head to the SEC for the rulemaking process, but they probably make it look like regulated investment crowdfunding. So I don't, I see the point. I just think there might not be enough awareness at this point if people don't know that you can just use crowdfunding, investment crowdfunding to raise that $250,000.
Okay. What are your thoughts on this, Eitan?
I agree with Woody. From a broker dealer perspective, my thoughts are, the idea of working. There's real costs of compliance, right, which is critical for this industry. There's advertising and promotional material review. There's reviewing KYC, know your customer, and anti-money laundering and OFAC, and a lot of the things that the broker dealer does on the diligence side that I think are designed to try to best protect the investor ultimately. And I think having those rails in place ultimately is best for investors and best for the industry. One concern I have is if you give an opportunity for issuers to avoid that level of compliance, and you lower the investment amounts, you risk a black eye on the industry if it's too easy for anyone to go out and take their investment and market it broadly online. I think you're going to have a decrease in quality overall. And if you look at the cost and the process that a company has to go through to launch a Reg CF offering, in my opinion, it's not that much, right? It's not like Regulation A, where you have more significant legal fees and a longer process with SEC and qualification. It's a notice filing. Yes, you have to have financials in place, which I think you should, right? If you're going to raise money, you should have some level of reviewed financials or audits ultimately. But I think that the Regulation CF structure already is in place that makes it easier for startups for a relatively small investment and not a lot of significant hurdles enter the markets and market their offering. So I have concerns about the micro offering exemption. That's my opinion.
Okay, well, so I'm going to take, that's good. You have a lot of experience in this. I'm going to take a slightly different opinion. So first of all, this, it's a bill, it's legislation, it hasn't been approved yet. Anything can change. We know how Congress works. They do their best to mess things up. But I think that I could see a system where these micro exemptions must list on a funding portal or broker dealer, because I believe there's a requirement in there that there's no bad actors. And I think that could assign a certain level of credibility to it. And I also think that maybe on some of these smaller platforms, it could be beneficial. I see there was another note here from Silicon Prairie about there's a requirement for audited statements after a certain point. And I can't recall if that's a requirement yet in the legislation, but I can see like we have an article today about Honeycomb Credit. It's basically a bank replacement platform. A lot of their offerings are less than $250,000. That could be something that could work for them, contingent upon the final rules. I think in general, anytime you streamline the process to get money to real companies that have a real business, in general, it's a good thing. I don't think you're going to see companies that want to be the next Microsoft. They're going to be using this. I think if it does come to fruition, it'll be a very a smaller, localized business, and maybe that's a good thing. It just depends. So that's my 2 cents of this. I'm going to jump to the next one that I highlighted, and somebody has already mentioned this one, Silicon Prairie, about the Reg A Improvement Act portion of the bill. They want to increase the securities exemption to $150 million. Today, it's $75 million, and at one point it was $50 million. And so I'm going to start with you, Eitan. What do you think about upping the funding cap for Reg A Plus?
So that I am pro. I'm for that, and some of the reasons are, well, first, it's not like you have so many Reg A issuers who are bumping up against the $75 million threshold right now. Nor did we have so many Reg A issuers who are bumping up against the $50 million threshold. However, by increasing it to 150, I think larger companies will take it a lot more seriously. That's a very big change, going from 75 to 150. And keep in mind that these are companies that have gotten audited financials, that have proper legal counsel in place, that have gone through the SEC qualification process. And so it's the opposite perspective as far as the micro side of making it easier for more companies. These are companies that have already gone through a pretty significant process. It would also allow for some of the funds or the bond issuers that are able to sell out of a $75 million Reg A, the ability to expand and raise more capital and allow more retail investors to participate in their offerings, instead of having to have a parallel Regulation D offering that's only open to accredited investors beyond the 75 million. So I think this would be a positive for the industry, and we have a number of clients I think that would benefit pretty significantly from a bump up in that way.
So, this could open up Reg A to more traditional IPO and offerings. What do you think?
Yeah, I mean, I love it. I think, when one of the things that I often talk about with legislators, mainly, you have to look at the type of company that is seeking capital and how much money they need, therefore which exemptions they're going to use if they're not going to have a public offering. Because, a lot of companies just don't want to deal with the cost of compliance with running a public company. And so, Reg CF fits, these very small companies. But when you're looking at these larger companies, what are the options that they have? They've got private equity. Maybe they were limited to that before, and that can become challenging. But by increasing the cap up to 150, I think it opens the door to allow these companies to explore even. I can get more money. I can actually play around with the retail investors, get a feel for what it's like to have them on the cap table, and maybe train them even better for an IPO down the road. But I don't see any harm in it. I think it's just what Eitan was saying. I think it's not going to be something for these small issuers. I think the really large companies that can benefit from this will leverage it. And I think that's sort of exciting.
Yeah, and I think we all know that companies are trying to stay private for as long as possible these days. And there's been fewer and fewer public companies in the past several decades. If you look back, you pull out the SPAC numbers, but you go back, and it's because of the cost of compliance. And Congress has taken a rule upon regulation approach, because they basically think that any new rule is a good rule, because without looking at the actual impact to the industry and who it impacts. And it can go too far, in my opinion, ends up being a tax upon the economy. So I think this is a good thing. I mean, I'd really love to see this come into play. The next one I have is, and I think this is kind of a layup, no brainer, improving crowdfunding opportunities portion of the bill. To remind you, a funding portal shall not be considered to be an issuer unless in connection with the offer or sale of a security. Basically, it's a liability improvement for the platforms. Eitan, I mean, thoughts on that very quickly?
Yeah, I mean, I think this would, I think ultimately this would take off some of the pressure perhaps from funding portals and allow for more funding portals to thrive without having that responsibility. At the same time, I could see it from the other perspective from an investor's perspective and some of the protections investors might want to be accustomed to receiving by having another layer of responsibility and obligation on behalf of the, from the funding portal side. But in general, I think that unless they're offering or selling securities, I'm pro this change generally. That's how I feel about it. But again, yeah.
I mean, I agree. My father was in healthcare and biotech and worked on CRISPR technology, and all I keep on thinking is, gee, if he wanted to take this CRISPR technology and go to one of these funding platforms and raise money on there, but he had a material misstatement on his CRISPR technology, there's no way these people that are running these funding platforms are ever going to know that that was wrong, because they're not in that industry. They don't have PhDs in that. So I think you need to match what the funding portal can do, which is in many cases a listing agent. Their job is to list offerings. And so, they should keep out the bad actors, but you can't hold them accountable for the, material misstatements in offering documents, which they would have no clue. So I think it's just logical to have it in there.
Yeah, I think it's kind of a no-brainer. Is it just limits a certain portion of the liability for funding portals, so they're not liable if somebody is doing something really bad. They still have to go through the whole bad actor thing anyway, which I know everybody does, and they do a pretty good job of it. There's been next to zero fraud in the Reg CF sector. So the next one is one that I know you're interested in, Woody. Restoring secondary trading market for private securities. This is a space you're kind of active in right now.
Mm-hmm.
Do you want to share your thoughts on that?
Yeah, I mean, there's something has to be done at the federal level to exempt these securities from state registration. Right now, to list your securities to trade on an ATS in these, if you have these private securities that are unrestricted and unregistered, you have to go, the issuer has to go state by state, essentially, and register the securities in the state in which they're offered and sold. And that makes no sense when it's a very thin marketplace for secondary trading and all that stuff. There is a manual exemption, which is an exemption that states if you publish ongoing disclosures, the companies can rely on this exemption to not have to file in each of the states, but that's not recognized by all the states. There's, I think it's up to 42 now. So if you've got this manual exemption concept at a state level, why don't we just elevate it to the federal level and come up with a unified rule that will allow for secondary trading to really evolve? Because I think the stickiness and the friction of having to deal with the states is really holding back the secondary market. If we can solve for that, then we can and the pipe's already there. Like, these ATSs have been developed and they're ready to go. We just have to create the opportunity for these issuers to come in under a federal exemption. I think that will really allow investors that want to get out to list these securities and trade them on these exchanges rather than wait for another exit. I think that's a tremendous benefit to investors that people that are looking at these laws should be creating.
Yeah, I think that creating a more effective secondary environment makes a lot of sense. Congressman McHenry was on the floor the other day, and he was talking about how we shouldn't make the private markets worse to improve the public markets, which that's what some senators and representatives want to do. I think it provides it could provide a nice exit opportunity for people who want to get out, and it's not yet an M&A or an IPO. Eitan, I know this is something you've looked closely at.
Yeah.
Just in general, what are your thoughts on secondary trading of these privately issued securities?
Well, there's not a whole lot of secondary trading yet going on in the private marketplace. I think that removing as much friction and hurdles to facilitate secondary market trading is a positive, ultimately for investors, so that they don't have to hold positions for an indefinite period of time, or that issuers don't have to make a tough decision about having to go through a difficult process to help facilitate the secondary market trading of the securities that they issue. So I'm very for removing friction to help facilitate secondary market trading. I don't think just doing that is going to create liquidity in the secondary market of private securities. I think there are some small type offerings with various structures that it's going to be very difficult to get active secondary market trading in. The issuer could allow for investors to come and go via bid and ask, but ultimately, what interests me most are getting some of these assets in the right structure, and facilitating market making down for some of these issuers and some of these securities that are going to be the larger ones, the fund structures. We're seeing this with music royalties, art, real estate funds, etc. I think those are more aligned for real potential secondary trading opportunities, whereas some of the startups, I think just having that, giving investors that ability to have in out, doesn't mean there's going to be liquidity, doesn't mean there's going to be an adequate bid, but I think we should lower the barriers to make it easier for issuers to help facilitate secondary trading for their investors.
I mean, the one other thing that I would add to that is, and Eitan's completely right. Just because you create a market doesn't mean you're fixing supply and demand. You're just creating the opportunity. But if you do create this and it does evolve and there is enough of a marketplace, what we're going to see, I think, is tremendously powerful. And that is valuation validation. Because there's no better gauge of what a stock's price is worth than what someone's willing to pay for it. So rather than having these exemptions where you say, I'm selling my securities at this dollar amount, you now have a marketplace where investors are saying, this is what I'm willing to pay for it. This is what I think it's worth. And I think that's going to control that. We've seen the valuation spike over the last couple of years. This type of opportunity, I think, would rein in valuations that have gotten crazy out of control. And allow investors, and yes, we're years away from this, but I think it'll keep valuations in check.
Yeah. The market's the final arbiter of what a firm is valued at, and VC math is not exactly math. Okay, I want to keep moving. I'm going to jump to, there's accredited investor definition. Somebody posted on here, is like, how would that impact some of these other exemptions? I mean, right now we don't know, because we don't know how it's going to be changed, but it does look like we're going to get some sort of change from, either side of the equation. We don't know yet, but there are two elements of this legislation that would impact the definition of accredited investor. The first one is the investment opportunity expansion. Accredited effectively means not more than 10% of net assets or annual income, which is a pretty simple approach if you can track it. I'm sorry, everybody's accredited now. Woody, do you want to thoughts on that?
I'm all in favor of increasing the size. Because we collect data and we just look at data. I look at average check sizes and I see that, everyone talking about this is the Wild West and people are going to be risking more than they can afford to lose. It's just not true. Investors literally are looking to see, what do I have in my cash pocket? What do I have in my savings pocket? And making decisions about, what do I want to allocate into this if I'm making investments as well. And so I don't think by easing it, you're going to be opening up the floodgates to fraud or people risking more. I think it just will allow people that haven't had this opportunity to really diversify into some of these offerings that they couldn't before. And I think that's a tremendous benefit, because that can democratize access, to wealth around the country. So, I'm in favor of it.
Eitan?
Look, the vast majority of private securities are issued through Regulation D. And I think giving more investors an opportunity to participate is a positive generally, but I think we have to be careful because there's a lot more disclosures that are required for some of the other exemptions, like CF and A in particular. So I think there is a responsibility to look out for the little guy and to make sure that they don't get too caught up with so many of the different Reg D opportunities that are out there. I think the idea of not more than 10% of net assets or annual income is interesting. It's similar to Regulation A, I guess, which Regulation A is based on self-attestation. I don't know if if the intention here is to track that in some way, but open to it, depending on, devil's in the details with that one. But again, we're always, we're looking out for the best interest of investors ultimately. And that's best for the industry, and that's our responsibility. So I think we have to navigate those waters pretty carefully.
And I also think there's ways in which they can not work around it, but improve it by, working with lead sponsors. If you've got a lead sponsor that's, to Eitan's point, the little guy is probably not going to read all the diligence documents or even understand them if he or she, were to. But where you've got these lead sponsors, and I'm seeing more and more of it, and I love it. Taking an active role in working with an issuer and determining what the right valuation is that they'll come in at. I think that creates, it's not that it necessarily 100% validates, but it makes sure that someone else that may be a little more sophisticated than you has taken the time to really dig into the company and understand what they're doing. And if they're willing to put a large check behind it, maybe you can rest assured, as long as everyone's on the same terms. I'm not saying that, they get special treatment for being that lead sponsor. If they're coming in at the same terms as everyone else, I think there's benefits in doing that. And you can do it that way.
So I agree with you. Unfortunately, that's not in this legislation. Maybe we can get it added in. But I'm going to jump back to the accredited investor thing because there's another aspect of this legislation. As it stands today, as Eitan mentions, the devil's in the details. We have no idea what's going to happen with this in the Senate. Even if Senate banking takes a look at it. Here's another aspect. Accredited investors include individuals receiving professional advice. That means you would have an IRA or a broker dealer saying, hey, you could take a look at this. Hey, Tom, what do you think about that?
I'm for that. And the reason why is because I feel it's a little discriminatory if just because someone has more money than me, let's say I have a better education and I know what I'm getting myself into and I'm getting actual investment advice from a professional and I could evidence that. I think that's reasonable to me, right? And in fact, that could be more reasonable perhaps than someone who barely qualifies as an accredited investor and is able to participate. So I think that makes sense. It's an interesting discussion, this idea of accredited investors, and it feels like every year there's another angle, another approach to it. But this is one that I think makes a lot of sense to me because it has to do with education. And if someone could evidence that they are educated about the risk that they're getting into, that they have a certain level of experience and they're getting advice from a professional, to me that it seems reasonable that they should have an opportunity to participate in Regulation D offerings.
Woody, thoughts?
Yeah, listen, I'm all in favor of that too. I think anyone that can help guide you in this sort of decision-making process in the private capital markets, I think is a benefit. I also think, if you can just show that you've made an investment and you lost your money, you should be able to do whatever you want because you've proven that you can understand what risk is. But, the way in which we look at it and from a very, like we're over here point of view is very different from the way regulators and legislators look at all this stuff. So, I love all this. I don't know where it'll shake out.
Yeah, I mean, in general, I don't want, a congressman or a senator making my investment decisions unless I get the same access to the information that they get. But I think, expanding the definition is just the right move. And we're going to come back to it again because there's something going on in the SEC I want to touch on. But I want to stick with the HR 2799 right now. Here's something else that I really like. Under the current legislation, they want to mandate a risk disclosure and investor attestation. Basically, I understand this is risky. I understand that I can lose all my money, not just some of my money. And when I do this, I'm making my own decision, and I understand that I can lose all my money. This, to me, makes a lot of sense. You're seeing this in some other countries. Woody, very quickly, pro con, yes, no?
I mean, yeah, we tried to put that in the original framework, and there's parts of it in crowdfunding where people are doing this on the platform before they can make their investment. So I see logic in it. You want people to understand that this is the riskiest form of investing. These are not public companies. There's no liquidity, immediate liquidity, and I think it's important for people to positively attest to that. Yeah.
Yeah, and sometimes public markets are pretty dicey too. Eitan?
Yeah, totally. I think those disclosures are critical. We're very accustomed to requiring them, and I think they're there for a reason. For someone that sees the marketing of a certain offering, comes to a website, sees an opportunity, and I think that needs to be balanced, fair and balanced in a way. So just like they're able to see marketing and promotion, they should also really be forced to see the risks that are very clearly laid out. And I think that makes a lot of sense to me.
Yes, every investment holds a level of risk, and without risk, we wouldn't have a market economy. So we need to, embrace risk, but we also need to understand it and appreciate it as individual investors and as a community. Okay, I'm going to speed things up here a little bit because we've got lots of stuff I still want to cover. Here's the final one from the legislation I want to touch on very quickly. It's called Increasing Investor Opportunities. This is where a closed-end company can invest in private securities and can list on an exchange. You already see this in other countries. Again, this is something else that I think should be a no-brainer. Woody, yes?
Yes, no-brainer. Yeah.
Yeah, no-brainer.
Yeah.
Eitan?
100%.
100%. And then finally, the SEC has held on the top of its agenda, because comes down to they can create rules too without legislation sometimes, and sometimes they create rules where they need legislation and they do it anyway. But they're looking at reforming Reg D or changing it. They call it improving it. I call it not improving it. They want to change Reg D, which is a very important market, and they also want to increase the threshold of being an accredited investor. I think I agree with both of you that a wealth metric is not the best measure. I think sophistication is a better one. I think we need to democratize access, and we shouldn't make it exclusive. We should make it more inclusive, as opposed to keeping it more for the elite and the already wealthy. Eitan, Woody, do you want to add anything to that?
I mean, I agree with you. Yeah.
Are we back?
Yeah.
Yeah.
I was just saying I agree with you. I mean, I don't see the need to make it any more challenging.
Yeah.
Yeah. I mean, I really don't understand why the SEC is going down this path. It's kind of nonsensical. It's, big government. We can make your decisions for yourself. Go spend your money in Vegas, buy lottery tickets instead. It just does not make any sense. When you go to business school, you always learn that you should take most of the risk when you're younger, and you should pump the brakes on risk when you get older. And the SEC wants to go against that. So hopefully we'll see a change there at some point in the not too distant future. Now, very quickly, I'm going to ask each of you to share what you would like to see that's not in this legislation going forward. What are kind of your dream changes for the securities crowdfunding ecosystem? I'm going to start with you, Woody, very quickly.
I want to see the cap go from 5 million to 20 million.
Yes. For Reg CF.
For Reg CF. I think we've proven that the model works, that there's been one case of fraud, that it's very, very difficult to commit fraud under Reg CF when you have to go through the hurdles of all the disclosures, the bad actor checks and all that stuff. Yes, it did happen, but there's much easier ways to commit fraud than through Reg CF. And so since we've proven it's working, since it's democratizing access to capital, let's just go up to $20 million and help the larger companies that want to benefit from this access that.
Anything else? That's your wish list right there.
That's my number one thing. Yeah.
It's a big one. It's a big one. Eitan, what would you like to see changed as a platform?
It's interesting because this is still a relatively young industry, and while I have a lot of ideas, I think it's important to observe and keep an eye on the statistics, and to keep an eye on risk metrics as well, which we see over time. I think it's included in this, but I think increasing the Reg A makes a lot of sense. I think increasing Reg CF could make sense as well. People are talking about going from 5 million to 20 million, but I think that should be driven by data, and it should be driven by how many issuers are actually raising $5 million through Reg CF, and what type of a need is there to really increase it beyond that. Again, there are some benefits from my perspective of going through the process of qualification with the SEC that ultimately could help protect investors better than some of the process that goes into ACF, perhaps, right? A notice filing versus SEC qualification. So I think increasing CF too fast, might not be the best thing, but perhaps it could be done in stages. But beyond that, there's plenty of opportunity right now with the laws as they are, with the regulations as they are, for issuers to take advantage of these exemptions, and for platforms to thrive by providing good service and picking up and taking on the right issuers, and growing their communities in that way.
Yeah, I guess I would kind of see the CF being a stepstone process, and you're seeing like the median each stage funding round has gone up over the years, even though maybe it's paused a little bit in the past year. And right now it stands like, I think, $14 million for some of these tech companies. So I think there's some merit there, and I think you get more seasoned issuers if you raise that limit. And I think that's a good thing for the platforms, and it's a good thing for the potential investors. Was there anything else you wanted to add that you're on your wish list, Eitan?
No, I'm satisfied with what is right now.
Good. I'm going to add one. Go ahead, Woody.
I just, if there was a way to help increase the compliance with these offerings, the fact that people aren't doing their the annual report requirement, I think we need to have the commission or someone show them how easy it is to actually do it, and maybe come up with a template for helping people do the the annual report, which is let's focus on the things that happen. Let's focus on what were the big changes that happened in your sales, what happened with your cash flow, things that investors need to know, like, are your expenses, did they increase, and what were the top 3 things that drove those increases? It doesn't, I feel like people might be thinking, I don't know why they're not doing it, or maybe they're just worried that they don't understand the amount that they need to disclose. But something is better than nothing. At a minimum, it's very easy just to post your numbers. So I don't even understand why people aren't doing that. But we need to have a sort of a template that these companies can use, so that we've got better compliance when it comes to the annual reports.
So I agree, people should be following these documents. My fear is the SEC will walk in with their big stick and start, pounding people in the head. I haven't seen an inclination for them to do that for CF issuers, but I like your idea about creating a form to make it really simple so people can be more compliant. We all understand that a regulated industry is a more sustainable industry, and so we want regulation. We just want scaled regulation that's applicable to the size of the firms and does its job without going so far that it'll kill the industry from the very beginning. And it is still in its infancy. So there's one thing that I'd like to add very quickly, to something that I've repeated many, many, many times in the past years. In the UK, there's a tax exemption. It's called SEIS, EIS. I'm not going to tell you what that stands for, but basically it's a securities exemption that allows an investor to write off a portion of that investment immediately the first year. And I'm streamlining this. And then if there's a capital gain on that investment, and we all know that these are risky firms for early stage, then you don't have to pay any tax on that. So what you've seen is you've seen the evolution of an industry where it incentivizes investors to back innovative young firms, and it helps to drive an innovation-driven economy. And I think that's vital. And if we could create something similar like that in the US, I think it'd be awesome. It also mitigates some of that risk. So if you think that if you put $1,000 into this early stage firm, and you get to take that $500 and write it off of your taxes, that's a good way to mitigate some of the risk, and it encourages people to help support these entrepreneurs. And we all want to support entrepreneurship because they create the jobs, they drive innovation, and they create wealth for everybody. So that's all I've got right now because we're really out of time. But I wanted to open it up for a couple of quick questions. I've seen a few fly here really quickly, and I'm going to hit a couple of these for you guys. Yeah, what are your thoughts on? Somebody said, "What are your thoughts on self-certification on the accredited investor?" Any one of you, Woody or Eitan, do you want to take that? I have an opinion, but I'm not going to share it.
I mean, I think people, if they want to do something, they're going to check a box so they can do it. So if you have a form that allows you to self-attest, I think people will use it however they want to use it. So, I like the fact that it takes the burden off the platforms or the broker dealers to actually have to do that, because it creates a friction in the process. But, I also see some logic in it, in having, some sort of proof that you are.
Okay.
Yeah.
So to keep going, somebody asked about the pending legislation. For everybody, it's HR 2799. It's Expanding Access to Capital Act. It's passed the House. Now it's in the Senate Banking Committee. The Senate Banking Committee is chaired by Senator Sherrod Brown. He's a Democrat from Ohio. He's going to be in a tight re-election cycle here this year. Please reach out to him and ask him to pass this legislation, because there's a lot of good stuff in there, in my opinion. You can look it up online. Just type in HR 2799. We also have a couple articles about it on Crowdfund Insider. Please do feel free to read that. Let me see.
And while you're looking at the questions, I'll just tell people what Andrew's saying is the most important thing. Having walked the halls of Congress, the number one thing I heard from people that work in Congress is, we listen to people that show up and reach out to us. So if you're just listening to this and you're not doing anything, it's not going to make any difference. And it literally is as simple as picking up the phone and calling. You'll get a staffer, and you can just say, this is really important to our economy, to creating jobs and all that stuff. They do listen, and they do report it to their bosses.
Yeah, and I've reached out to the press person in Brown's office, and he has not gotten back to me yet. Not a good sign, but please do reach out to Sherrod Brown's office and tell them to pass this legislation. What are post-funding reporting to investor requirements in CFA and Reg D? This is something I kind of like, because I think the industry needs to do a better job of investor communication, investor management. Eitan, what are your thoughts on that?
I don't have the list right in front of me, but I think that the more post-funding reporting requirements, the better, ultimately, to keep investors in the know. And again, because of the breadth of the different types of structures and industries and share class structures that private securities are issued through, I think we have to look out from the investor's perspective. Once they make an investment in a private security, are they going to hear from the issuer? How are they going to track that investment? It's not like they could open up the newspaper and see a bid and ask. So I think that there should be some requirements that require issuers who take advantage of these exemptions to be obligated to keep their investors in the know with basic information. So I'm for that, and I don't have the specific list that you're for CFA and D right here, but I think that the more communication and the more requirement for communication, the better. Yeah,
good. So Bobby, I agree with you. We should coordinate with the ACA if you're with the ACA, please reach out to me. They've done some really good stuff advocating on behalf of the industry in general because interests are aligned. There has been some communication, but it needs to be more. Let's see what else. Eitan, can you kind of describe I saw some comments here about the differences between a funding portal and a broker-dealer, and actually funding portals will list Reg A's and Reg D's as well. A funding portal was created by the Jobs Act. It's kind of like a broker-dealer light. Eitan is a broker-dealer. He understands what you can and cannot do when you're a BD versus a funding portal. Maybe you can share that very quickly, Eitan.
Yeah. So funding portal is a crowdfunding funding portal typically, and crowdfunding portals are able to list regulation CF offerings and receive compensation, receive commissions for regulation CF offerings. While they may be able to list other exemptions like regulation A and regulation D offerings, they are not able to charge commissions for those. They could charge perhaps a flat fee. In that regard. Whereas a broker dealer is able to, provided that in their membership agreement with FINRA, they're able to help facilitate the sale of private securities. They would be able to list Reg A, Reg D, and Reg CF, and they're also able to charge commissions for the successful sale of those securities, which is a very big difference. Therefore, CF portals, funding portals are typically limited just to regulation CF offerings with an occasional listing of a different securities exemption that they treat differently.
Thank you for that. Very quickly, somebody was asking about secondary platforms and use now that are legal. Yes, there are a couple platforms that do mainly Reg D offerings. And then there are some entries into the other exempt securities. With Reg A, you can choose to trade immediately after the offering. We've seen that happen too. We've kind of touched on this a little bit. I think this is a pain point in the industry that needs to be addressed with legislation because I'd like to see it more robust. The UK, one of the platforms in the UK, I think they've done a good job for these private securities issued on a platform, and I'm hoping to see that evolve in the United States.
If people want to see some of these secondary platforms, the SEC has a list of the ATSs that are registered with them, but Templum and PPEX are two of the ones that we work with at Guard that do that secondary trading of the collectibles and like Masterworks and a lot of those artworks or type of stuff. So that's worth checking out.
Yeah, I totally agree. And it needs some work. It can be better, and it can be a good thing for the industry overall. I'm going to ask each of you to give your final thoughts here before we call it quits because we're already past the top of the hour. Eitan, what are your thoughts? What do you want to share your wisdom with the people that are here?
Yeah, we're really focused on founders and on helping guide founders understand the different options that they have to take advantage of these different securities exemptions, including how to increase the ability to raise capital for their funds through the registration of captive sales force personnel with our broker dealer, which enables them to be able to pay commissions to reps that end up working for them as well. So there's a lot of different strategies that issuers could learn about, could utilize. You reach out to Dalmore and talk to one of our sales personnel. We're happy to kind of guide you through our perspective through the different options and show you the different technology solutions that are available and talk about what's working and what isn't in the marketplace. So that's where I would leave off, and we look forward to speaking to anyone who's out there who's considering launching an offering, and we have a lot to share.
Woody, final thoughts?
Yeah, I mean, if you're listening to this, thank you. I think the most important thing is for you to take what you're hearing and go talk about it with other people, not just people that you think might be interested in it, but your family as well. One of we've been talking about around our dinner table is investing in startups and small businesses, and it's a great educational tool. It's a great way to create generational wealth. There's a plethora of data now around this industry, please reach out to me about that, because we're not, we've got 3 times as many companies now that have been on the New York Stock Exchange. This number is only growing. So learn from the data, let the data drive your decision, and rest assured that the logic that's taken place in this marketplace is something that we should all be getting behind in terms of helping expand it rather than figuring out ways to contract it.
Awesome. My final thought is email Sherrod Brown's office. Tell him to bring that to the committee vote, and let's get this legislation pushed forward. It's an election year. He's up for a tight election. He may be more inclined to help the little guy a little bit and help small businesses. Hope springs eternal. Other than that, I want to thank everybody for joining us today. I want to thank our 2 panelists. They're awesome and excellent. I'm sorry Doug couldn't make it, but we're blessed with the appearance of Eitan Butler, Dalmore Group, and Woody Neese, the OG from CCEA. And hopefully everybody who's in attendance today will join us next month for our next webinar on securities crowdfunding. Thank you very much. Everybody have a great rest of the day.
Thanks, Andrew. Thanks, everyone.